Inflation is a big worry. So we will wait and watch and not cut interest rates anymore right now. But that doesn't mean we will stop or end the easy money policy, because we will continue to do whatever it takes to push growth. That was the message from RBI Governor Shaktikanta Das this morning when they announced the Monetary Policy Committee meetings proceedings. And that is the theme of our IlaNomics discussion today. I am YP Rajesh, managing editor at ThePrint. But before we go to our discussion, I have a question for you. How many of you have taken subscriptions to ThePrint? And if you have not, you should take one now. Because let me tell you, it is not so easy to keep such a young and large media organization, startup in a sense, going without your subscriptions. You are very valuable readers and viewers, and your subscriptions are very important to keep the momentum of good journalism we have been striving to do at ThePrint. We are unhyphenated, we are neither left nor right, and we just believe in the facts and the story. So please log on to theprint.in and take a subscription today. You will be doing a very, very valuable service to the cause of good journalism. Hi, Ila. So this was some kind of an expected announcement from the RBI. Inflation is now above the comfort level of 6 percentage points, 6%, and the RBI has paused. So your column today, which was just published a little while back and which will be available to our readers on in the description of this video, also on the website, says that this is the best option. Uh, how can you be so unequivocal about this?
These are very, very rare times. It's not a normal, typical situation where, you see, okay, inflation is high. So monetary policy means that monetary policy should be tightened. If the committee meets, then the committee should raise rates. These are not normal times. In fact, I don't think inflation targeting, the targeting framework in any country has ever faced a situation like this, where it has to figure out what is this inflation that is happening. That demand is slow, that demand is weak just because there was a lockdown. I mean, so even if we don't look at any other factors, even if we try to really, really simplify the parameters of what would go into a monetary policy committee meeting decision, then we would say that, oh, if there's a lockdown, demand must be weak. But in a situation like this, if inflation is high and if it's being caused either because of supply constraints or, as the RBI said, because of indirect taxes, because of issues that have arisen due to, let's say, the COVID or the lockdown situation, then you don't want to apply your typical monetary policy framework thinking at the moment. Now, you can't even ease rates to support growth because inflation is high, while at the same time you can't raise rates to respond to that higher inflation, because it's not as if that inflation is because of overheating and high demand. That is why in our column, Radhika Pandey and I, my co-author Radhika and I, have argued that this was the best that the MPC could do. And I think this is pretty much what almost everybody expected. So all economists who have been interviewed, everybody pretty much expected that the best thing that could be done at this time is to keep rates unchanged.
Ila, can we place this MPC meeting and the announcement in the context of what has happened in the last week or so, and also in the context of what is coming on the cycle, the economic cycle? One is we got numbers for Q2 GDP, and it was slightly surprising in the sense that it was better than expected. The contraction was less than what had been forecast. Number one. Number two, this is the last MPC meeting before the budget in February. So what kind of message does the MPC deliberations and the MPC decision today send to the government, which is drafting the budget? I mean, the process of making the budget has already begun.
Let's start with the GDP numbers. Now, the GDP numbers were better than what a lot of people expected. Uh, they indicate that the economy is getting back on track. And one of the most important things for the economy to get back on track was a removal of the lockdown. So I think the lesson that we learned from quarter one was that we don't do this countrywide lockdown because it leads to a lot of disruption, supply disruptions, if and a mechanical effect as well, that if people don't go out, then they can't produce. So income will go down, wages will go down, people will lose their jobs. So in terms of GDP numbers, it looked like, yes, GDP numbers are positive now. Positive, they're negative. They're less contractionary, and the news is about GDP is positive. And there, the monetary policy stance was that it is still contraction. It is, even though the numbers are better than what they were expected to be, but it is still a contraction. And even though the RBI had actually forecast a bigger contraction, and so it is less than that. So we need to continue to remain accommodative. We need to continue to support this growth, and that's, I think, the indication as far as growth is concerned. Now, if I turn to the budget and what might be the indications from this meeting and its decision for the budget, then it is not, then it's saying that we are not cutting rates, we're not making it even cheaper for you to borrow. And if the economy is picking up and rates are not being cut further, then the government needs to continue to be to raise to collect taxes, to be fiscally prudent as it has been so far. So had rates been cut, it could have been that, okay, we are not worried about the inflation, we also think that government should be able to borrow more cheaply, and so rates are being cut and you can have an expansionary fiscal policy. But here, by keeping rates unchanged, it is giving a gentle message. It is not raising rates. It's not giving a very strong message for cutting fiscal deficits or for fiscal prudence. But it is a sort of a gentle message that, y- we're not making it cheaper for you.
Mhm. Ila, when the GDP numbers came last week, there were two kinds of headlines or kinds of interpretations. One was people call it a technical recession, a second quarter of contraction, second consecutive quarter of contraction. So there is a technical recession. India is in a technical recession, and I thought, those were the people who were looking at the glass half empty. And then there was the other section which said the contraction is less than what was forecast. This is good news. There are green shoots. Where do you stand?
You see, if you look technically at the NBER definition of a business cycle downturn or a recession, then a contract two consecutive quarters of a decline in GDP give you a recession. In fact, that term is usually not suitable for India because we don't get two consecutive declines in GDP. We've actually, I mean, in the last 25 years we've not seen that. We saw that in about 91, 92 last that we saw it. It doesn't happen because what we see are growth slowdowns. So we don't have that kind of a recession, the NBR definition of a recession. So I mean, I don't go with that first view because uh, as any emerging economy, business cycles don't follow the developed economy business cycles. And then suddenly, because we are in the midst of a pandemic, because things are, this is a once in 100-year episode, then suddenly we forget what EM business cycles look like, and we suddenly import the definition of a developed country business cycle. the NBR definition, which has not been suitable to our business cycles, which was suitable only to the monsoon shocks and the oil price shocks that we saw. Actually, we've only had three such episodes since independence. The first in the mid 60s, when there was a monsoon shock and an oil price, two consecutive monsoon shocks. Then in 71, when there was an oil price shock and a monsoon shock together. And then later, just before the big economic crisis we had in 91, 92. But uh, to then suddenly, after 25 years, when we've all been, those of us who've been working on business cycles and have been talking about EM, or emerging economy business cycles, and why they are different, and we've done a lot of research on that, and on business cycles in India and how business cycles in India don't follow the developed economy cycles, then to use that technical definition is actually, in my view, incorrect. uh, in terms of the, on your question of is it green shoots, uh, it is removing the physical restrictions. So some of it is also pent up demand, some of it is festival demand, some of it is that we can get back to work. When the lockdown related restrictions were removed, we could get back to work. So I think it's a lot of that happening, and it was very, very difficult to come up with numbers like 9.8 or 8.7. And actually it was quite surprising that people were making these very accurate sort of predictions, because when you work with the macroeconomic models to try to forecast GDP, you have like 20, 25 equations out of, and you have like 20 endogenous variables, and those were not even measured when these predictions were being made. So I think it was very brave but not very realistic to come up with numbers like 9.8 versus 8.7 or 3.6. So such precise numbers in a situation where one didn't know what was going on, one could not measure many things, GDP was not back on track. And now also, I think we are almost in the same situation. Yes, a lot of it is that we feel that things are coming back on track. You can track what is happening to companies, what is happening to their sales. But then there is a very large informal sector, and we haven't captured all the data. So there are I wouldn't call them green shoots. I think it's the economy getting back on track, and that is happening with the removal of restrictions, with removing with pent up demand and festival demand, and that's all very good. But I wouldn't, be come up with these accurate numbers either of predictions or even of measurement of GDP.
Mhm, mhm. Ila, I'm going to pester you a little bit since I've not been a student of economics, so please bear with me. Why do they call it a technical recession? Does it mean it's not a real recession?
The NBER definition, the National Bureau of Economic Research of the United States, defines a rule of thumb for what is a recession. That definition says that two consecutive quarters of a decline in GDP constitute a recession. So if in the US economy, though now, they also look at many other things. They look at many other indicators as well. So they've also developed their methodology. But going back to Mitchell and Burns, who worked on various indicators. So they looked at a lot of economic indicators, and that was in the 40s. So if you go back to the work of Mitchell and Burns and you trace back so NBR has a dating committee that dates business cycles. So they would date a recession, that the recession started at this point and ended at this point. Now, originally, when they came up with that definition of what is a recession, then it was two consecutive quarters of GDP. I think what we're doing is using it a bit loosely.
Mhm.
That's my sense from what I
No,
can
but,
make
but
out
why
from,
use the word technical, Ila?
because that was the definition, that
Acha,
that
okay.
technically, okay, that was
Mm,
a definition. Whereas they would say that we look at sales, we look at employment, we look at hours worked, we look at purchases, orders, and a lot of other coincident and leading indicators for studying what a business cycle is. While they were doing all of that, but this was one of the definitions. So call it a technical definition. YP, you should ask those who are using this term actually. To be
No,
fair.
but you're the economist,
But
Ila.
I'm only second guessing that this is what
Mm.
people mean because this is the NBR definition.
Ah. So, you have concluded your analysis today by saying that the RBI and the MPC face a complex policy trade-off when, deciding on rates and inflation and growth and all of that. Why is it a complex policy trade-off?
Because when you have high growth and high inflation, things are easy. You can raise rates. If the high growth and high inflation are both because of very high demand, the economy is overheating, everybody's producing beyond capacity, then it's very easy. You know which direction to go in. Similarly, if you have low inflation and low growth, then also it's easy. You cut rates. Okay. Now, when you have a situation like this where you have inflation, you can't quite figure out what the inflation is due to. Earlier it was felt maybe transport is insufficient, there are supply constraints, but then you got harvest, which was fine, which you got, the food prices are still up, but it's not very clear because it's happened due to a factor which is not there in the economic models at all. The kind of lockdown we had is not there in any economic model. It's very difficult to figure out how to balance between high inflation and low growth in an unprecedented situation like this. So it's a very complex situation.
Ila, we have a lot of viewers asking us questions, so I think we should go to the viewers and see what they want to know today. I have a question from Arjun on Twitter. Ila, he says, "Ma'am, what are your views on the new GDP figures of 7% decline in the second quarter? Is this just pent-up demand which could end in the next quarter or two? And when can India go back to positive growth?"
My sense is that a lot of it is opening up of the economy and people are getting back to work. To some extent, yes, there is pent up demand. People had postponed consumption. To some extent, it is the festival. But I don't think it is short lived. I think it's not that we're going to collapse again into the quarter one situation. It's not a situation where, there's a complete lockdown. Of the kind that we saw in quarter one. So, May and June, were completely closed. So, I don't think we're going to fall back. But I think recovery will happen. And it won't be that slow. I've been a little more positive than some of the others in terms of the recovery, that the recovery will not be that slow because we're not that dependent on government spending. We're not that dependent on public investment. I mean, earlier also we were all crying that there isn't enough of that happening, or enough of government spending, public investment, this and that. I think it's primarily a private economy where when people come out, get back to work, things will come back on track. That's my hope and my expectation.
The next question is from someone who has just signed in as PVS. Thank you, PVS, for your question, and I wish we knew your name. Uh, how much can RBI control through monetary policy when the loan uptick is lower? And also, I guess he means when credit offtake, and also when the CPI and WPI are not in sync.
Yeah, so I think credit offtake being low is an issue, and that people are not wanting to borrow at a time like this. There is uncertainty. There is uncertainty in terms of if I produce today, will I be able to sell it? So, should I build up inventories? There is uncertainty in terms of investment, certainly long term investment, there's uncertainty. So, it is not that easy. Monetary policy already was, difficult enough. Transmission wasn't happening. You will remember the last 2 years, we've been talking about how the RBI has cut rates, but banks have not cut rates and credit has not picked up. Already, that was the situation. And now, in the midst of that, we have COVID and we have a lockdown, and that has increased uncertainty. So, it is certainly an issue and it is certainly a problem.
Thanks, Hila. We have a very regular follower, Parimal. Thank you, Parimal, for coming back to IlaNomics. Uh, RBI's balance sheet has expanded at a rate much higher than in previous years. Can the inflation be attributed to increase in money supply? Isn't inflation a monetary phenomenon? There is too much money in the system.
To some extent, yes, there is, because there's been a lot of capital inflow thanks to easy monetary policy in the West, and this often happens that capital flows in, and RBI tries to prevent the rupee from appreciating. In the process, it buys up dollars, which is what it has been doing now, and pumping liquidity into the system. Now, normally, if there is an increase, so that leads to an increase in reserve money, and that, if the money multiplier were to be the same as it normally is, which would be through an increase in credit, then it does lead to an overheating in the economy. But currently, that money multiplier is not working out to its full. So you've got an increase in reserve money. You've got an increase in the RBI, an expansion in the RBI balance sheet, but you haven't had the increase in money supply at the same rate. So, that link is getting broken. And therefore, at least theory would not predict that you will get an increase in prices because of this factor. So, I don't think at the moment the inflation that we have is a monetary phenomenon.
Mhm. Thanks, Hila. Tarun Mangatil is another regular viewer. Tarun is asking us, Madam, isn't it time to increase FDI cap in banking sector from the present 74% to 100%? I know it's not related to today's developments, but
Well, on this, I mean, my view has been that one is that we should be more liberal on this. I mean, if, we want to borrow, loans go bad, and their equity holders are willing to suffer, then we are beneficiaries of the process. So if someone outside is willing to, I'm a diabetic, I want to eat gulab jamuns, and you want to take the risk, you want to loan money to me, I don't have a problem with that. Of course, along with that, RBI will have to do the usual prudent microprudential regulation, which would mean that deposits stay inside the country and money doesn't go out, and that, or the other way around. But I agree with you that yes, we should increase the FDI cap.
Raja Mukherjee is asking a question about the value of the rupee. He says, do you support devaluation of the rupee for the sake of exports which are worth about $370 billion when the rupee is already very cheap? Exports are mostly commodities anyway. Devaluation will push up oil prices and that would be further inflationary.
So I am of the view that the rupee should actually be allowed to be far more volatile than it is. So I would neither push for an appreciation or a depreciation. I would neither want the rupee. No, I wouldn't want the RBI to step in and try to manage the value of the rupee. I mean, yes, there are pros and cons. You see, always, yeah, if you make it weaker, then there are advantages and difficulties. So your exports will become cheaper. If it were weaker, exports would be cheaper, but companies would have more currency risk on their balance sheets because they have a lot of dollar denominated borrowing. So it has pros and cons. Similarly, if it was stronger, then imports would become cheaper. Maybe imported prices would come down. So we have an exchange rate pass through for prices, and that would come down, so it would be cheaper imports. But then maybe people may think that let me borrow a lot more if it is going to continue to strengthen, and they may acquire more currency exposure. I think eventually, because as we grow, first of all, the ability of the central bank to manage the rupee without all these other difficulties that it creates, that ability goes down. The uh, ability of RBI to intervene and move the exchange rate. So let's say that it intervenes, it buys $1 billion worth of reserves. Then how much would be the change in the exchange rate of the rupee? Even that becomes weaker and weaker as the forex market expands. So I think as an economy expands and as an economy becomes more integrated with the world economy, whether through capital flows or through trade, then the best thing that we need to prepare ourselves for is rupee volatility. And that's what will make us more resilient, rather than saying, oh, should we try to weaken it or should we try to strengthen it?
Uh, the stock markets, Ila, have been just climbing and climbing, and we are at 43,000 levels on the Sensex. The Nifty has crossed 13,000, and I mean, it's the rise has been dizzying. The fall and the rise this year has been dizzying. And Malkhed Sushil asks us a question about this whole stock market phenomena. Do you feel stock markets rose with hot money of foreign investment or due to domestic liquidity provided by the RBI?
See, there are many factors that determine what happens in the stock market. I mean, if I try to, include these two, then there are these, then there are many others. There are expectations about the economy. There are questions about how liquid, how many other stocks that money is flowing into. So, is it that money is flowing into just a few stocks, and there is a true track stock market as well, so that some the companies that are in Nifty or Sensex are doing well while the others are not doing so well because a lot of money is flowing into those. So I think this is a very, very complex issue, that is that what determines stock prices. And I wouldn't venture to give a simple answer like this, that there is just this or that and I favor one versus the other, because I think a lot of these factors are playing into this, as well as, if I may add, because interest rates are low,
Mhm.
there are people want to move they want returns for their positive returns for their savings after, when inflation is high and interest rates are low. You don't want to put your money in banks, so you want to look for avenues which will give you more returns. So that's people's behavior. So in the inflation rate, the monetary policy, the monetary policy of the domestic economy, of the foreign economy. So there are many, many factors that play a role in this.
And also to just add there was this new phenomena, Ila, that has been widely reported that because of the lockdown and a lot of people sitting at home and they didn't know what to do with much of their time, a lot of people entered the markets, and they've been called the new retail investors who entered the markets during the lockdown, and that number is supposed to be in the tens of thousands. So maybe some liquidity came from there as well. Last question, Ila. We are running out of time. And this is a question from someone who calls himself Vladimir Putin. But obviously, that's not the Russian president asking us. I wish it was. Can we expect a rescue package or infrastructure stimulus package?
Don't be too optimistic. There
Mhm.
might be a package, but I think if there is a package, then it would be in some ways something that leverages a small amount of money. So something like if the government can put in 10,000 crore, 20,000 crore, but in such a manner that it leads to much higher investment. Direct public spending and direct public investment with a lot of money requires a lot of fiscal space, and currently we don't have a lot of fiscal space. So there could be something, but that would have some complex financial structure and a lot of leveraging, and we'll have to wait to see how it would work out, because some of the things that we've seen haven't really worked out too well on this.
I was about to wind up, Ila, but I just saw a very interesting question from Siddharth Kulkarni on YouTube. So I want to take that question and we'll give them a brief answer and wind up. He says, does the RBI's monetary policy have a sizable impact on the economy in India? Because even when we had high inflation from 2008 to 2013, the RBI must have cut rates, and now similarly, credit growth is low.
No, so the inflation targeting framework was actually adopted first in 2015 with the Monetary Policy Framework Agreement, and then in 2016 with the change in the law. Before that, RBI would sometimes raise rates, sometimes cut rates, sometimes focus on the rupee. Even when the economy was slowing down, it would start raising rates to strengthen the rupee. Uh, we saw that in the taper tantrum episode. So we did not have an inflation targeting framework in the period 2008 to 13. In fact, if I may venture to say that one of the reasons why an inflation targeting framework was introduced into the in the country was because of the experience of what was done and the period even before 2008, but the experience with not having a framework in place and then trying to achieve multiple objectives with a limited number of instruments. So I don't think that's the right time for an analysis of what an inflation targeting framework does.
Thank you so much, Sheila. I think we've already overshot our time limit and it's gone on. I mean, I want to thank our viewers and for sending so many of those questions. We will be back next week with another episode of IlaNomics next Friday live, and we will notify the time. So please do track us on Twitter, Facebook, as well as our website. And please do also subscribe to the channel, the Print YouTube channel, and there are lots of other videos, and you will definitely like them. Stay tuned to the print, and we will be back.